Thanks to the Taxmann team for providing me an opportunity to speak on this platform, especially on the business restructuring part. So during the next 60 minutes, basically, we will discuss about the what are the options that we are available available under the Income Tax Acts as far as this business restructuring is concerned. So, so this is the agenda for the today's session, and we will discuss about all the options that are available under the Income Tax Act. Like we will discuss about the amalgamation or the merger. What are the procedure and what are the exemptions and other taxation aspects that we need to take care of. So we will all discuss about all the things under the amalgamation part. Then we will discuss about the demerger and slump sale. Fourth one is the share acquisition. Fifth one is the asset sale. So suppose a company want to sell its assets and what are the tax implications on that part as far as the restructuring part is concerned. And the sixth one, we will discuss about the others areas wherein the company can look into the restructuring, like by way of a buyback of its shares or capital reduction or the restructuring under the Insolvency and Bankruptcy Code. For last 5 minutes, we will take the questions and answers and solve all the queries if any. So now let's take all the options that are available and we will discuss one by one. So please confirm, anyone, can you please confirm whether my voice is audible by giving the thumbs up on the screen? Yeah, thank you. Thank you. So now let's take all the options one by one. First, we are going to discuss about this amalgamation or the merger part. So amalgamation or merger, basically, the Companies Act has defined under the section 230 to 232, defined the procedure about the amalgamation and the merger. Amalgamation, merger, both are the same thing. Both are the synonyms of each other. So, but the terminology has not been defined under the Company Act. But Companies Act has only defined the procedure about the approval part from the court or from the NCLT point of view. But in the general way, what is the amalgamation? Amalgamation means one company is going to buy the another company, wherein the transfer company is going to cease and the another company will take all the assets and liabilities of the transfer company. So in simple language, we can say that this is the amalgamation or the merger. But the Companies Act has not defined any type of definition. However, the Income Tax Act has defined the definition of the amalgamation, because this Income Tax Act plays a very pivot role as and when you will do this business restructuring. Because from the taxation point of view, you have to take this decision as far as the strategic part is concerned. Unless and until you comply the taxation point of view or you comply the taxation laws, you have to pay the taxes. So that's why this income tax plays a very pivot role as far as this business restructuring is concerned. So the definition which has been given in the Income Tax Act. So Section 2, Clause 1B has defined the merger or the amalgamation, basically. So amalgamation, as per this Income Tax Act, means the amalgamation in relation to companies. Companies means it will be applicable only and only for companies, not for the firm, not for the HUF, not for the other type of the entities. So it will be applicable only for the companies. So as per Section 2, Clause 1B. So means the merger of one or more companies with the another company, or the merger of two or more companies to form one company. So that means one company is going to merge with the another company or with the another company in the simple language. But we have to comply all the conditions which have to be meted out as per the Section 2, Clause 1B. What are all the conditions? The conditions are all the property of the amalgamating company. Let me clarify that the language or the terms which are using in the Income Tax Act is that the transfer company is the amalgamating company and the transferee company is the amalgamated company. So these two terms has been used, like amalgamating and the amalgamated company. So first condition is that all the property, so property has not been defined in the Income Tax Act. So as per the statutory, as per the judicial pronouncement, it includes all type of tangible as well as the intangible part, right? So all the property of the amalgamating company or companies immediately before the amalgamation becomes the property of the amalgamated company. So that means all the assets, all the property, whether it is tangible or intangible, will become the assets and assets or the property of the transferee company or the amalgamated company. On the similar lines, all the liabilities of the amalgamating company will become the liabilities of the amalgamated company. So that means the transfer company will transfer all the liabilities, all the assets, all the properties to the amalgamated company. That means to the transferee company. The third condition that the shareholders holding not less than three-fourth in value of the shares become the shareholders of the transferee company or the amalgamated company. The word is shares. Shares could be your preference share or share it could be your equity shares, but it should be shares. If you issue the shares, if you issue the consideration in the form of bonds or debentures or other type of instruments, that will not be qualified as an amalgamation in the Income Tax Act. So that we keep in mind that share should be issued as a consideration to the shareholders of the amalgamating company, right? So these are the three conditions. And there are certain things that we need to keep in mind, that the acquisition of the property should not be in a silo basis, or the asset should not be taken over on the piecemeal basis. That will not be counted as a amalgamation or a merger as per this Income Tax Act. So when we talk about this restructuring as per the taxation point of view, so we need to take care of the all the section which are interrelated with the amalgamation part, like section 21B. Section 47 is defined what is the transfer, and what are the exemptions in relating to the transfer by one company to the another. The third section is the section 72A relating to the carry forward of losses. So when we talk about this amalgamation, it should be tax neutral. Tax neutral means that all the conditions which have been prescribed in the definition part, that need to be keep in mind. Only and only in that case, this amalgamation will be tax neutral, and you don't need to pay any tax as and when you will do this restructuring as per this income tax point of view. So when we talk about this amalgamation, all the related sections we need to keep in mind, and we will discuss one by one in the later part of our discussion. So there are the various judgments as far as this amalgamation is concerned, right? So I have plotted out 5 judgments which are very critical as and when we will do the amalgamation as per this taxation point of view. The first is that the Grace Collis judgment by this Honorable Supreme Court, which states that amalgamation is a transfer basically. So transfer has been defined under Section 2, Clause 47. So when you see this Section 2, Clause 47, the transfer, there's no any terms relating to the amalgamation part, right? So there's no any condition or no any items defined for the business restructuring part. So in the Section 2, Clause 47 states that the extinguishment of any rights therein, right? Extinguishment of any rights. So suppose a shareholder who is getting a share in the amalgamating company, that will be treated as a transfer, that because through this amalgamation, the shareholders will get the new shares in the amalgamated company or to the transferee company. So that will constitute as a transfer. But Section 47 has defined that it will not be treated as a transfer if you meet out the condition which has been stipulated under the Section 47. So it's a very good judgment. You can read it out, the Grace Collis, because this was the overturned by the earlier judgment or Rasik Lal, wherein the Supreme Court held that this is not the amalgamation will not be treated as a transfer, because that was the erstwhile Act 1922 Act. But after this 1961 Act, the terminology has been used, which is called the extinguishment of any rights. So this amalgamation is a part of extinguishment of any rights therein. So this judgment will be applied over that part of clause. The second thing is that as and when we will do this amalgamation or merger or the restructuring through this NCLT or the court procedure, what is my appointed date? Because through this appointed date is the amalgamation or the merger will get effective. So Marshall Sons and Company is the very landmark judgment wherein the Supreme Court held that the appointed date proposed in the scheme itself will be treated as the appointed date for the consideration. because this is through this appointed date, all the accounting and finance, all the regulatory part, all the taxation part will get effective. So it's a landmark judgment, so you can read it out because it's a very crucial thing. Third judgment I have plotted out is that as and when this amalgamation became effective, so there's a judgment called Maruti Suzuki India, in which the Supreme Court held that through this approval of this amalgamation, the amalgamating company is going to cease. So that means that there's no any effect as and when the amalgamation implemented. The any type of notice, any type of assessments will become null and void on the amalgamating company. The fourth thing is that prior to this Finance Act 2022, there was no any statutory provision as far as this filing of returns for this restructuring of activities. Like if suppose a company want to do the amalgamation or the merger, and it will take 1 year, at least 6 to 12 months period of time for the approval from the NCLT and other regulatory authorities. So there was no any provision available under the Income Tax Act to file the income tax return. So Dalmia Power judgment, which in which the Supreme Court allowed to file the revised returns, because this business reorganization is a statutory activity which has been approved by the NCLT or to the by the court. So the Supreme Court then allowed to file all the returns in case of the reorganization or restructuring of business. However, the same has been statutorily recognized under Section 170A of the Income Tax Act, which defined that I think 6-month period has been given for submission of the returns after this restructuring of activities. The fifth one is that the whether this amalgamation can be refused in case of the tax avoidance, because it's a very debatable issue after this implementation of the GAR, General Anti-Avoidance Rules, basically, because it can be treated as an impermissible agreement wherein the income tax department can challenge the amalgamation or the merger. It's a very debatable issue, basically, after the introduction of the GAR. But there are the couple of judgments wherein the courts have held that there's a difference between this tax avoidance and tax planning, like McDonald and Company Limited, wherein the Supreme Court held that there's a difference between this tax avoidance and tax planning. So you have to identify whether this transaction is going to be for the tax planning purpose or for the tax avoidance purpose. So there are the couple of judgments which we can hold that we need to keep in mind while doing our restructuring of activities as far as the business part is concerned. And recently, there are the couple of NCLT judgments wherein it is held that the income tax department can't have a right to, at the time of the approval, that this should not be, this agreement or this type of arrangement should not be approved because it's a tax avoidance. So recently, there was one judgment called Panasonic India, wherein the Chandigarh NCLT has held that at the time of the assessments, the income tax department can apply the GAR, not at the time of the approval. So these are the various debatable issues which can be discussed in a very lengthy way. But these judgments basically define the way how to restructure our business, how to think, how are the matters that we need to keep in our mind while doing the restructuring. So we have discussed so far regarding this definition part, Section 2, Clause 1B, and various judgments. So when we talk about this tax neutral, as far as this amalgamation or merger is concerned, so Section 47, which is we need to keep in mind while applying this restructuring activities as a strategic part. So Section 47, as far as this amalgamation is concerned, Clause 6 and Clause 7, states that no capital gain on transfer of the capital assets, either in the hands of the transferor company or to the amalgamating company or to the shareholders, because the amalgamating company will transfer all the property and the liabilities to the transferee company or to the amalgamating company, and the shareholders will get the shares in the amalgamating company, only shares, not the debentures or bonds or any other type of instrument, only shares. So these are the conditions that we need to keep in mind. Only and only in that case, the amalgamation or merger will be tax neutral. So that means it will not be treated as a transfer. You don't need to pay any capital gain tax as and when the amalgamation or the merger will happen, provided that the amalgamated or the transferee company should be an Indian company. If suppose it's a foreign company, the transfer will not be, the amalgamation will not be tax neutral. It will be treated as a transfer as per the Grace Collis, the Supreme Court judgment, that the amalgamation will be treated as a transfer, and the shareholders as well as the company both have to pay the taxes. So section 47 clause 6 and clause 7 which specifically states that it will not be treated as a transfer, provided the transferee company should be the Indian company. Now, what are the other things? What are the other tax implications? As and when the amalgamation will happen, all the property will get transferred from the amalgamating company to the amalgamated company. So as far as this the assets and the block of assets, suppose you are going written down value assets, you are going to transfer all the assets to the transferee company. Whatever the cost that they are appearing in the books of the in the books of the amalgamating or the transfer company will be treated as the WDV or the actual cost in the hands of the transferee company or the amalgamating company, as per explanation 7 to section 43 subsection 1 and explanation 2 to section 43.6. So 43.6 is basically for the written down value, and 43 subsection 1 is relating to the actual cost of the assets. So depreciation will get the pro rata basis as per the fifth proviso will get apply, and as and when the amalgamation will get apply or will get happen, the depreciation will be on the pro rata basis on the date of the transfer or on the year of the transfer. We can say that no tax holiday period will be available, so that it will get lapsed, and the benefits of this tax holiday period will not get applied to the amalgamated company. Expenditure on the amalgamation, so tax will be deducted, tax deduct transferee company, so in the 5 equal installments as per section 35 DD. So any cessation of liability or remission of liability or any income arising due to that liability, trading liability, for against which the expenditure has already been expense out in the previous years. So any benefit arise out to due to this remission or the cessation of liability. So any income will be treated as an income of the transferee or to the amalgamated company as per section 41 clause 41. So section 41 and subsection 1. So what about the periods of holding? So section 2 subsection 40 section 2 clause 42A define about the period of holding. So period of holding for the assets which has been transferred by the amalgamating company to the amalgamated company or by transfer company to the transferee company, that period will get included. Whatever the period the assets is being held under the for the transfer company, that period will be included for the transferee company as and when the transferee company will sell the assets. On the same part, the shareholders, that period will also get included. Whatever the period they will hold for the amalgamating company, that period will also be included for the period of holding for the amalgamated company. Cost of acquisition has been defined under section 49 subsection 1, wherein whatever the previous owner's cost, that will be treated as cost for the amalgamated company. So these are the key tax implications as far as this amalgamation or the merger is concerned. So now suppose a company want to take the benefit of these losses, unabsorbed losses, carry forward of losses and unabsorbed depreciation. So we can say that because these are the very strategic decisions, a company want to do the restructuring for the taking the benefit of carry forward of losses and the depreciation part. But section 72A will get applied, which states that all type of losses or all type of depreciation you can't be carried forward by the transferee company. It will be carried forward or the benefit of the carry forward of losses by the transferee or the amalgamated company will be available only and only when you have to meet out the section 72A conditions. What are those conditions? The amalgamating company should be an industrial undertaking or a ship or hotel. And what is the industrial undertaking? The section 72 has defined, like the manufacturing or the public the electricity company. So they have categorized into 5 or 6 parts. These are the industrial undertaking or a ship or hotel. So suppose a hospital want to take the benefit of the merger and want to take the carry forward of losses, a service industry. So all type of industries not going to or not allowed to take the benefit of carry forward of losses and depreciation. We have to meet out the conditions as per the industrial undertaking definition as per section 72A. Only and only in that case, the losses benefit and the depreciation, unabsorbed depreciation benefit are going to benefited by the amalgamated company. The other conditions are the amalgamating company should hold the assets for 5 years. So the amalgamated company means the transferee company should hold the assets for 5 years, at least 3/4 in the value of the fixed asset. Suppose an amalgamation is happened, and in case of the loss undertaking company, the transferee company should hold all the assets for 5 years, at least 3/4 in the value of the asset which is appearing at the time of the transfer. So this is the one conditions. The second thing is that the amalgamated company should carry the business for 5 years. So all the conditions we need to take care of at the time of the restructuring of our activities and fulfill such other conditions. Other conditions has been prescribed under Rule 9C of the Income Tax Rules 1962. The specified condition says that the amalgamated company means the transferee company should achieve a level of 50% of the production level at the of the your installed capacity at the time of your transfer. So that means you have to achieve the 50% of your production level after certain period of time from at the end of your transfer. Only and only in that case the benefit will get available, right? And certain other conditions the government has specified, like you have to give the accountant certificate at the time of the return of filing, whether your production level has been achieved or not. So all these conditions has been prescribed and need to be fulfilled at the time of the restructuring your activities of the income tax activities. And for the amalgamating company, there are the certain conditions. So that means if suppose a company you have formed a company and the company is into losses, and 1 year the company is into losses, at the time of your incorporation or at the end of your 1 year, you can't do the restructuring or your activity because the period they have prescribed the period. So that means you have to be in your business for at least 3 years or 3 years in your business. Only and only in that case, this carry forward of losses will be benefited by the amalgamated company. So the business should be in existence for at least 3 years, and the certain type of book value of assets need to be held for at least period of 2 years prior to the date of the amalgamation, at least 3/4 in value of the book value of the fixed assets. So that means the Income Tax Act under Section 72A has prescribed the conditions for carry forward of your losses by the amalgamated company. Certain conditions need to be fulfilled. Like you need to be having the criteria, or need to fulfill the criteria of the industrial undertaking part. The second condition that the amalgamated company should carry on the business for at least 5 years, and they need to hold the assets at least 3/4 in the value for at least 5 years. And the amalgamating company as well, like they have into the existence for at least 3 years prior to the date of the incorporation of your company. And the losses after fulfilling the condition of Section 72A, the losses and the unabsorbed depreciation will be allowed for fresh 8 years. Unabsorbed depreciation is for infinity period, there's no time period, but for these unabsorbed losses, it will be allowed to carry forward for fresh 8 years period of time for the transferee company. So that was all about this amalgamation or the merger part as far as this taxation point of view. Now we can take the second option which is available under the Income Tax Act, which is called the demerger. So amalgamation is a very simple process wherein the one company is going to merge with the another company, or two companies can merge with the another company. Like all the property and liability will get transferred to the another company, means the transferee company. So this is amalgamation, is a simple thing. But in case of demerger means that one of the segment the company can carve out and can sell it to the another company or to the another business area. It's called the demerger, basically in a simple language. The Income Tax, however, the Income Tax Act has defined what is the demerger is all about. After meeting all the definition, only and only in that case the demerger will be tax neutral. Tax neutral means at the time of your demerger activity, when you sell out your business, transfer your business to the another undertaking, transfer your undertaking to the another business or another company, you don't need to pay the taxes on the demerger part. The section 2 clause 19 AA defines the demerger. So demerger in relation to companies, company means as applicable for the amalgamation part as well. The companies means only the companies. It will not be applicable for firm, for HUF, or to the partnership firm. However, section 47 has defined that a company can the convert into the LL.B. It will not be treated as transfer provided the certain other conditions you have to fulfill out. But for the demerger part, it means it only the companies only. So demerger in relation to company means transfer pursuant to a scheme of arrangement under section defined under section 230 to 232 by the demerged company of one or more undertaking of to any resulting companies. There are the two things. One is the demerged company, another is the resulting company. Demerged company means the transfer company, we can say. The resulting company means the transferee company, in which the undertaking is going to transfer. So the undertaking has been defined under the Income Tax Act. What is the undertaking is all about? Undertaking, we can say that it's a segment area of one particular company, and they are going to sell or going to transfer that undertaking to the another company. The conditions are that all property liabilities, all properties of the undertaking become properties of the resulting company. All the liabilities of the demerged company becomes the liabilities of the resulting company. The second condition is that the transfer of property or liabilities should be at book value, except for the India's companies wherein the fair valuation is allowed, but revaluation is not allowed. So all the undertaking, all the transfer should be at the book value only. The third condition is that the consideration discharge by issue of shares to the shareholders on a proportionate basis. So the consideration should be in the form of shares only. Shares could be your equity shares, it could be your preference shares, but not in the form of debenture or bonds or any other type of instrument except shares, right? So proportionate basis. So what is a proportionate basis? Proportionate could be as given by the registered valuer on the basis of swap ratio, right? Swap ratio. Shareholders holding 3/4 or more in the value of shares in the demerged company become shareholders in the resulting company, right? So these are the fourth condition. So shareholders at least 3/4 in the value become the shareholders of the resulting company, and the resulting company will give a shares to the shareholders at the time of the demerger itself. The transfer of the undertaking should be on the ongoing concern basis. It should not be on the piecemeal or asset sale basis. Conditions to be notified under section 72A subsection 5 have to be fulfilled, but however the government has not notified any conditions till date for the demerger of the activities, which has been defined under section 219 AA. So this is the demerger basically. So now the word is given is the undertaking, one or more undertaking. So now let's discuss about the meaning of the undertaking, because that is a debatable area when you do the demerger activities from the litigation point of view. Undertaking has been defined in the section itself. Undertaking means any part of the undertaking or a unit or division of undertaking or a business activity taken as a whole, but doesn't include individual assets or liabilities or any combination thereof, not constituting a business activity. So suppose merger is a very simple process, but in a demerger, you have to segregate your undertaking. So now the question is, suppose there are the three segments, segment A, segment B, and segment C in my company, and I want to carve out my segment A. So now the question is whether all the assets in the undertaking need to be transferred to the resulting company, or I can pick one item. I can make my own judgment what type of the assets I need to transfer to the resulting company. So that is the debatable issue. The Delhi High Court in Indorama Textile Limited has defined this definition of the undertaking. The Delhi High Court held that the assets should be in the form of business activity. Business activity means that through which my business carry on. Without these assets, I can't run my business. It will be part of my undertaking. Suppose I have 10 type of assets in my financials or in my balance sheet. Suppose investments, I don't want to transfer it to the resulting company, but the definition says that all the property and liability of the undertaking. So that means all the assets means all 10 items I have to transfer to the resulting company, or I can left one item like investment or other some immaterial item like land or some other items I can skip out for this demerger part. So that is a thing which defined by the Delhi High Court in a very famous judgment that the asset should be in the nature of the business activity. Through business activity means if this asset is a very important part for my running the business, that will be counted for as an undertaking, undertaking part. So if suppose I can say that, okay, this is the investment, I don't want to take it to the resulting company, because without investment I can run my business. It's a strategic investment, or it's like bank FD or like simple other investments I can skip out as per this demerger part is concerned. So we have to make a choice, we have to make a decision whether this activity is a part of my business or not, because at the time of your assessment the tax department will give a challenge. This type of your restructuring demerger will not be tax neutral because you have not transferred all the properties to the resulting company. So this thing we need to keep in our mind while doing this restructuring part as far as the demerger part is concerned, right? Now let's take about the key tax implications for the demerger activity. So no capital gain tax in the hands of company as well as in the hands of the shareholder as per section 47, right? So as and when the transfer, as and when the share, the company will transfer its business to the resulting company, and the shareholders will get the shares from the resulting company, right? In proportionate to their value, will not be treated as a transfer, provided the resulting company should be an Indian company. If it's a foreign company, then it will be treated as a transfer and you have to pay the capital gain tax. The same thing will get applied to the shareholders as well. The shareholders will get the shares in proportionate value, and it will not be treated as a transfer. Share means it should be a shares, not any other type of instrument like bonds, debentures, right? It should be shares. It could be your equity, it could be your preference shares. The cost of the shares for the shareholders in the resulting company, the formula has been given under section 49 clause 2C, which has prescribed that the basis on the value on the basis of the net book value and the net worth of the demerged company. As for the dividend part is concerned, section 222 clause 5 prescribes that as and when the shares will get the shares in the resulting company, or the shares given by the resulting company to the shareholders of the demerged company, that will not be treated as a deemed dividend, right? So dividend conditions will deemed dividend will not be there at the time of your demerger, or at the time of the demerger, or we can say that at the time of the shares shareholders get from the resulting company. The same condition like as we discussed in section 41 in case of cessation of liability. So any income will be treated as for the successor company, means the resulting company. The business assets cost and the written down value, the same has been given under explanation 7A to section 43(1). So actual cost of transfer assets in the hands of the resulting company will be cost in the hands of the demerged company. So whatever the cost, that will become the cost of the resulting company. Depreciation proportionate will be there as per the fifth proviso. Earlier it was sixth, now it's the fifth proviso of section 32, and the depreciation will be on the basis of the proportionate basis. So WDV, the explanation 2A, the same, the reduced by in the books of the demerged company, whatever the assets that we are going to transfer to the resulting company, the WDV will get reduced from the book value, the block of assets from the demerged company, and the same will become the WDV of the resulting company. Loan borrowing not specifically related to the transfer undertaking will be apportioned in the ratio of the assets transferred to the total value of the assets, right? So all assets which are specifically available or specifically marked for the demerged company or for the undertaking purpose, that will be transferred. Suppose they are the general borrowings, or the other borrowings, which is not specifically categorized for this undertaking. So that will be proportionate on the basis of the book value of the assets. The benefit of the losses and the unabsorbed depreciation will be available for the resulting company. But in the case of the carry forward of losses and unabsorbed depreciation, the benefit will be available for the unexpired period. In the amalgamation, that will be available for the fresh 8 years. But in case of the demerger, that will be available for the unexpired period. So conditions notified under section 72A subsection 5 need to be fulfilled, but no condition has been prescribed. Right. And any change in the value of the assets on the revaluation, as I've discussed earlier, that need to be ignored. So these are the demerger conditions that we need to fulfill out. If suppose any of the conditions has not been prescribed, suppose I have issued the debentures, it will not be treated, it will not be tax neutral. If the demerger is for the resulting company is a foreign company, that will not be treated as a tax neutral. If shareholders doesn't become the shareholders of the resulting company of at least 3/4 in the value, it will not become a tax neutral. So that means all the conditions we need to fulfill out. Apart from that, there are the other options available, like cross-border demerger or cross-border merger and acquisitions, or the amalgamations part. I have, due to the time constraint, I'm not included my presentation part. I'm just discussing about the Indian context only. So one more important thing is that in case of this merger part or the amalgamation part, so Finance Act 2021 has prescribed that there is no depreciation on the goodwill, right? So as per the Smith Securities judgment by the Supreme Court, so goodwill is a intangible assets, and the companies can take the depreciation on that part as well. But 2021, the Finance Act 2021 has made the amendment that there is no depreciation on the goodwill. So while doing these restructuring activities like merger or demerger activities, so and whenever the consideration will be extra, it will be treated as a goodwill. Goodwill, no doubt, is your intangible assets, but no depreciation will get allowed from 2021 onwards. So that will be need to keep in mind at the time of restructuring our activities, that no depreciation will be available. So the scheme can be framed in that way as well. So that was all about the demerger part. So far we have discussed the merger. Second, we have discussed the demerger. The third thing we are going to discuss about the slump sale. So now let's discuss about the slump sale. In a simple language, I can say that slump sale is equivalent to a demerger. Means you are going to carve out of one of your undertaking and going to sell to the another buyer. In a simple language, the condition is that without assigning any value, there is no any value assigned to the assets which you are going to transfer to the transferee company. So that is the slump sale in a simple language. Now let's look the definition which has been given under the tax statute. Section 2, clause 42C has defined this slump sale. So slump sale means the transfer of one or more undertaking, the same language they are using. Undertaking means one of the undertaking you are going to transfer by any means for lump sum consideration without any value being assigned to individual assets and liabilities in such transfer. Means there is no any value assigned and you are going to transfer for a lump sum consideration, right? The word uses that by any means. Any means by exchange, by giving consideration in the form of shares. Consideration can be in the form of debentures. Consideration can be in the form of cash in bank or any type of consideration. Earlier, prior to this 2021, the amendment was made in the 2021 Act. Prior to that, the word was sale. This by any means, there was a word by sale. Sale means there was a judgment of Bombay High Court, which prescribed that Bombay High Court of this Bharat Bijli Limited, the Bombay High Court held that for the slump sale, because it's a slump sale and the word was mentioned, the undertaking by sale. So now they have substituted the word by any means. Sale means it should be in the cash consideration only. Cash means it includes banks, but not by issue of the debentures or by any type of instruments, because it's part of exchange rather than it's a sale part. So that's why they have overturned the judgment of the Bombay High Court of this Bharat Bijli Limited, and now they have statutorily recognized that the slump sale can happen by any means you can issue shares, debentures, and any type of the instruments. But in amalgamation and the demerger, you have to issue the shares only. The only and only in that case should be tax neutral, right? So slump sale is not a tax neutral. Section 47 doesn't give you exemption about the slump sale. You have to pay the capital gain tax as per section 50B. So 50B has prescribed the procedure for the calculation of the capital gain for the slump sale purpose. So undertaking, the definition which we have discussed for the demerger part, same will get applied, and the Indorama textile judgment of the Delhi High Court, the same will get applied as and when this slump sale undertaking, transfer of the undertaking, because the question would be whether all the assets or one of the assets can be left out as per my decision making power, right? So that is the thing that we need to keep in mind while doing this restructuring of your business. Consideration in the slump sale, consideration will be given into the company rather than in the hands of the shareholder. So earlier in the amalgamation and the demerger part, consideration was given to the shareholders only, right? So for the amalgamation as well as the demerger part, the company is not going to get any type of the benefits. Only then this merger and the demerger would be tax neutral. So slump sale is not a tax neutral. Shareholder will not get any benefit. The company is going to get the consideration in the form of cash, bank, or any means, right? So the cost of the acquisition. Now the question would be, cost of acquisition of the undertaking can be a portion on the assets forming part of the undertaking at the value determined by the registered valuer. So in the section 47 and 49 has prescribed that whatever the costs that are appearing in the books of the transferor company, means for the amalgamation as well as for the demerger part, that will become the cost for the resulting company as well as for the amalgamated company, means the transferring company. Here, there is a no value assigned particularly, right? So the question would be, what would be my cost in the books of the taxes, in the tax books? Whatever the assets that have transferred without assigning any value. So the answer is on the value which is determined by the registered valuer will be treated as a cost in my taxation, in my tax books. Cost apportioned by the transferring company will be considered for depreciation under section 32 Income Tax Act, right? So you can get the depreciation as well. So on the basis of the value which has been assigned by the registered valuer, you will get the benefit of the depreciation as well by the transferring company. So capital gain has been defined under section 50B. So capital gains, the procedure is, or the method given is the fair market value minus net worth. So cost, so it's very difficult to identify the cost of the undertaking. So the law has defined that net worth of the undertaking will be treated as my cost, right? And the fair market value of the assets which is going to be transferred will be treated as a full value of consideration. So this fair market value has also been amended in 2021 Act, wherein earlier it was the sale value, sale consideration minus net worth was there, but now they have defined that if the sale is less than my fair market value of the asset, the fair market value will be treated as a full value of consideration. And they have defined the net worth as well. Net worth means whatever the WD with the assets for the depreciable assets and the book value of the assets other than the depreciable assets will be treated as will be calculated as a net worth of the undertaking. So change in the value of the assets of the revaluation will not be accounted for as per the net worth is calculation. The net worth is concerned for the cost of the acquisition of an undertaking. Benefit of the indexation is not available. Losses and the unabsorbed depreciation part, it will remain with the transfer company. That will not get allowed to the transferee company, right? To the buyer, we can say that. So now the question would be, in case of slump sale, whether it would be a long-term capital gain or it will be a short-term capital gain. So 36-month period will be need to see for the undertaking part, whether my undertaking is 36-month old or not. So that will be treated as a long-term, otherwise it will be treated as a short-term. So undertaking, it can be that one of the assets we are having a 5-month-old period that will not be accounted for, right? So we have to see the undertaking. Undertaking means all the assets will be part of the undertaking. If it's a 36-month-old, so that will be treated as a long-term capital gain. So the benefit of the slump sale and the demerger as a strategic part on a comparison basis at the time of the restructuring activities, that can be compared. We need to see whether the demerger is benefit or the slump sale activity is benefit, because in the demerger, shareholder will get the benefit. In the slump sale, the company will get the benefit because the consideration part, and they have to pay the capital gain tax as well. The fourth option is share acquisition. So far, we have discussed the three things: amalgamation, second is the demerger, third is the slump sale. Fourth one is that the company can acquire the shares, right, on a simple basis. If companies are going to control the another company, they can acquire the shares on a simple basis. So what are the conditions and what are the income tax aspects, key tax implication we need to keep in mind? So from the buyer's perspective, right, if I'm going to acquire a shares of a company, right, we need to trigger out section 56 to clause 10 of the income tax act. It's a very debatable section, which states that if I'm going to acquire a property means shares and the other type of instruments of the another company, if its consideration is less than fair market value, so fair market value will be treated as a full value of consideration, right? So section 56 to clause 10, we need to see at the time of the acquisition of the shares whether I'm going to acquire the fair market value or not. Fair market value has been defined under section rule 11 UA, right? So the same has been defined that rule 11 UA has prescribed the formula that what type of the activities we need to, what type of the items we can say that we need to take care of while calculation the fair market value as per the taxation point of view. And the capital asset has been defined under section 2 clause 41. It includes all type of property, whether connected with the business or not, right? So simple, first on simple basis, I can say that at the time of the acquisition of shares, whatever the consideration you are going to pay, you need to compare the fair market value of the shares. Quoted shares, there's no any question because the price will be available. For the unquoted shares, because the listed price or the prices are not available, we need to calculate as per the rule 11 UA, and whatever the difference, that will be treated as an income under the other sources. In case of the section 79 will get attracted in case of change in the shareholding of more than 51%. So losses, if you are going to acquire the shares of the another company, and if there are any losses, that will not be allowed for the existing company because the shareholding will get changed by more than 51%. That we need to take care of. From the seller's perspective, these sellers will have to pay the capital gain tax first of all. Second thing is that the on the parallel basis, section 56 to clause 10 will apply for the purchaser buyer part. Section 50 CA will get applied for the seller part as well. If he is going to get the consideration in less than the fair market value, the difference will be treated as a income as well. So these are the things when we will do the restructuring, whether I'm going to acquire the shares, section 79 will be attracted or not, section 56 to 10 will get attracted or not, or section 50 CA will get attracted or not. So all these type of the decisions or all type of the sections, we can say that we need to keep in mind while doing the strategic activities of our business. Now let's take the another option number 5 is the asset sale simpliciter. So asset sale means you are going to sell your assets on a piecemeal basis. Piecemeal means that in the acquisition part or in the demerger part, I'm going to sell all the assets and liabilities to the transferee company, and the transfer company will seize up. Means they will wind up without dissolving the company. Suppose the company want to continue in existence basis, but they want to sell all the assets, right? They want to sell all the assets. They can transfer the assets on a piecemeal basis. So that is also a strategic decision whether I can go by a demerger part or by slump sale part, or by assets on a piecemeal basis part as well. So I have to pay the capital gain tax as well, right? Section 45 and 48 define the full value consideration, and section 50 has defined the capital gain for the depreciable assets. So the capital gain would be short-term capital gain for the depreciable assets. So whether you are having the carry forward of losses, whether this type of capital gain will be treated as a business loss, because there's a couple of decisions by the judicial authority wherein it states that although it's a capital gain, but for the carry forward of losses or set off for your losses, it will be treated as a business loss or business loss. It will be treated as a business gain. So there are the various decisions we need to keep in mind, whether this type of asset sale will be helpful for us or not, or we can go by demerger or slump sale, or by way of piecemeal of the sale of the assets. The last but not least is the other options available. So other options we can discuss into the three ways. One is the buyback of shares. Buyback of shares means that the buyback was introduced, I think, in India 1999 in the Erstwhile Act, 1956 Act. Which prescribe that a company can buy out its shares. Buyout means the company is having a very surplus capital in their hands, and they want to reduce their capital as per the restructuring activity. So buyback was allowed in 1999, and now Section 68 has referred this the buyback portion as well. The company can purchase its own shares. So at the time of the buyback of the shares, the companies have to pay a tax on the distributed profits at the rate of 20% plus surcharge. Section 52 QA will get applicable on the part of the companies. There will be no capital gain in the hands of the shareholders, first of all. Earlier, prior to 2019, there was a condition for the listed and non-listed companies. Now they have removed this condition. It will be applicable for all type of buyback, whether you are going to buy back by this listed company or by the unlisted company. The company have to pay the 20% tax plus surcharge. There was one judgment of the Board of Financials by the Mumbai ITAT, which states that Section 56 to 10, because the company is going to acquire its shares, whether the Section 56 to 10 will get applicable or not. The ITAT held that the acquisition of shares is not my property, because the shares are dead in the dead form. So Section 56 to 10 will not be applicable. However, in the hands of the shareholder hands, there's a no deemed dividend as per Section 222 clause 4, and the distributed income of Section 115 QA will be exempted in the hands of the shareholders as per Section 1034. So only company have to pay the tax. There will be no taxation for the shareholders. The second thing is the capital reduction. Capital reduction can be through court procedure or the non-court procedure, but mostly it's court procedure. So capital reduction will be treated as a transfer as per Section 2, Clause 47, and which is confirmed by the Supreme Court in Karthike v. Sarabhai, that capital reduction is treated as a transfer because the extinguishment of your rights. So as the deemed dividend is concerned, for the capital reduction, it will be treated as a deemed dividend in the hands of the shareholder. Clause D specifically says that to the extent of the accumulated profits at the time of capital reduction, it will be treated as a deemed dividend, right? It will be treated as a deemed dividend. Anything which is over and above your accumulated profits will be treated as a capital gain in the hands of the shareholders. So this is also confirmed in the CIT versus Narasimhan G by the Supreme Court, that because there's no any specifically section for the capital reduction part, how the capital gain will get calculated at the time of the capital reduction. Although the Section 2 subsection Section 2 clause 22D has prescribed that deemed dividend would be there, but how the capital gain will get calculated, it is confirmed by the Supreme Court in the Narasimhan judgment. Right, so anything which is excess of the accumulated profits will be treated as a capital gain. The last thing we can discuss in the restructuring as per the Insolvency and Bankruptcy Code, IBC. So IBC was introduced in 2016 for the purpose of ease of doing business of the, and as well as the insolvency process, easiness of the insolvency process. Also, restructuring can happen in the as per the IBC law as well. So in parallelly, the income tax law has also been amended as and when the restructuring is happened through the IBC. Section 79, because Section 79 says that as and when 51% shareholding will get changed, not for the public public interested companies, you can't allow to get the benefit of carry forward of losses, right? But Section 79 has amended that, wherein the acquisition is happened through IBC, the IBC, so carry forward losses will get allowed for the buyer company as well. So that was the first of the amendment made out in the Income Tax Act. The second thing that was amended in Section 115J states that in case of the resolution plan admitted by the NCLT, the reduction of aggregate of the brought forward losses and unabsorbed depreciation will get allowed. However, for the another companies, lower of the reduction of the unabsorbed depreciation and brought forward losses will get allowed. So resolution plan has been defined in the Section 5 of the IBC, which also includes that resolution plan. It can include the merger acquisition part as well, the merger part as well. So Section 238 of the IBC has override all other law as well, which means it override the Income Tax Act as well. So due to that, Section 79 and other various amendment has been happened. So as and when the restructuring is happened through this IBC, so we can take care of this Section 79 and the MAT provisions as well. So from this slide, so I can say that I have concluded my discussion. So if there's any questions, so I can take it up. So over to you, Komal.
Sir, you can take the questions from the Q&A section.
Okay, thank you. So there's a one question is, suppose X and Y tax holiday under 10A, both company goes into the merger. Then when benefit of 10A is available? No, sir, there's no benefit available for this tax holiday period as far as this Section 10A is concerned, because it specifically allowed that there is no any benefit available as and when any restructuring transaction has happened.